This is Radio Free Wall Street with Lee Adler on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, it is June 7, 2014, and I'm going to go behind the Wall Street paper curtain and all the misinformation, disinformation, and irrelevant information to cover a few of the things that I think really matter. And first we're going to review the reverse repo data that we talked about last week. Turned out that was entirely relevant and exactly as we expected. So we'll take a look at that. Some of the liquidity indicators, the technical indicators, where they're pointing the market is headed. So let's get to the data. First, let's review the reverse repo situation. First, I want to follow up on the discussion we had last week on the Fed's reverse repo program and why I've been watching that and why I think it could be important. Just to refresh your memory, the Fed's reverse repo program is a temporary open market operation. Prior to 2007, temporary open market operations, or TOMO, were the Fed's primary means of executing monetary policy. They did occasional outright coupon purchases or permanent POMO operations to keep the balance sheet growing at approximately 5% a year prior to 2007. I don't know why they chose 5% a year, but apparently that was their magic number, and that's what they did. Then with 2007, they started all the emergency programs and all the creative means of injecting funds into the market, most of which didn't work. And then a couple of years ago, they came up with this reverse repo expansion program. They've always done reverse repos, but they expanded it to include not just the primary dealers, but also banks and money market funds. In a reverse repo, the Fed lends securities to the counterparty, and the counterparty lends the Fed cash. Now, these operations so far have been strictly overnight operations, and basically it was a means of moving the spaghetti around on the plate. The funds would move from bank reserves into reverse repos. They were overnight funds, so to me they were the same as cash. We don't know who the counterparties are specifically. We don't know if the majority of them are the primary dealers or the money market funds or the banks. But we do know that the funds are available and can be used for whatever these institutions choose. So I figured we better keep an eye on this, because as these funds build up from mid-April here, when the federal government collected taxes, and then for the rest of April began to pay down debt all the way up to here. Sorry for the poor drawing. Let me erase that. So that as the Treasury was paying down debt from all the taxes it collected in mid-April, it paid off all of the cash management bills that it had issued in February and March to fund its operations, and the additional other short-term bills that it had increased. So it paid down a couple $100 billion between the middle of April and the middle of May. So we saw the reverse repos rise from $75 billion here up to, at one point, $220 billion. This is a weekly chart that comes from the Fed's H41, but every day the New York Fed publishes these operations as well. And we know that at one point, a couple weeks ago, it got up here to $220 billion. So, over that period of a couple of weeks, I was talking about the fact that as the stock prices were kind of remaining flat, and these reverse repos were rising, it meant that the former holders of the Treasury paper were forced to park the funds in these reverse repos at the Fed. They had no place else to go with them. There was not enough short-term paper around for them to invest in, so they turned around and lent it to the Fed, eventually getting up to $220 billion in cash that they had lent to the Fed on an overnight basis. And I said, look out, folks, this could be tinder for a rally. Well, starting at this point here, towards the third week, fourth week of May, the reverse repos outstanding began to fall. We talked about this last week. They got down to about 155 billion as of last Friday. As of Wednesday, they were only here, but by Friday they were down here. And look what has happened. Now this is the line stops. The weekly line stops here at 100 and just under 150 billion as of last Wednesday. But look what happened on Thursday and Friday. We dropped all the way to 101 billion in reverse repos outstanding. So from 220 to 101 billion, 221 billion actually, 120 billion in reverse repos that various counterparties had lent to the Fed overnight came out of these programs, and at the same time, stock prices have risen to up here. There would seem to be a correlation between these reverse repo funds coming out of the Fed and going into the market. And that was what I was concerned about. So I think this is something that we need to keep an eye on going forward. Watch the level of these reverse repo funds day to day. You can follow it on the New York Fed website. I will update this stuff weekly in the Wall Street Examiner Professional Edition Treasury Update, and I'll talk about it here at Radio Free Wall Street from time to time. It's clearly something to keep an eye on as a potential signal for what's going to happen with stock prices. Next, let's take a look at a couple of the charts from the Wall Street Examiner Professional Edition Daily Market Update. I'll start with the third rail chart that I've gone over with you, I think, last week. And it shows the S&P in a melt-up channel. It has broken out above the broadening tops here. And I thought it would hold at 1930 or so, but it went right through that like a knife through butter. And it has formed this little melt-up channel here that appears to be aimed at about 1965, 1970. Support is now around 1940 in terms of the melt-up channel, and 1930 down here from these other old channel extensions. Here's a cycle chart of the S&P 500. These channel projections here, the red, which is the 13-week cycle, and the green, which is a 6-month cycle, they were actually projecting through here a few days ago, and or last week. Now they've broken out, and these channels have begun to curl upward. And it would appear that they're probably aiming for the top of this 18-month cycle channel projection here as it approaches 2,000 in July. It is possible that this channel may also be curling upward. And if it is, it's too soon to tell, but if it is, then this rally could surpass the 2,000 level. But for now, it looks like it's headed for a target in this area here around 1980. At the same time, you can see the upturns in the upper portion of the chart in the various cycle indicators. The 4-week and 6, 7-week cycles are moving higher. They're not overbought yet. Same thing with the 13-week cycle, although there may be a trend line here that could represent a potential peak, but normally the prices, the index itself doesn't top out on the first peak. There's normally a little bit of a negative divergence. Now we do have a negative divergence, a larger one going back to November, but if this continues, they're going to break through that in the next couple of days. Again, you see the upturn in the 6-month and the 10, 12-month cycle indicator. And these cycles are early in their turns here. So that, if you're a bear, that doesn't bode well for the next couple of months. And finally, 10, 12-month cycle momentum has also turned up and looks like it's breaking through a base pattern here. So these are all very bullish technical signs for the time being. There's not really any reason to expect an important top to develop in the near term anyway. You can see the problem for bears even more clearly in the long-term chart. Here, you can see on the weekly bar that it has broken out of the top of that broadening pattern or megaphone pattern that began late last year. And it appears on this chart that there's no significant resistance until you get up to around 2050 or 2100. That would be the top of the long-term channel, and I certainly would not expect to see the market go beyond that. And we're at 1950 now, so we're between 50 and 100 points away from the target. And that sounds like a lot, but when you consider that the S&P is at nearly 2,000, it's not even 2.5 or 3% to get that high. So it's not a big jump to go from where we are now, 1950 to 2000 or 2100. Again, you see the upturns in the indicators that suggest that this move may just be getting started. So that's the technical picture. If you're a bear, it's ugly, but things can change, and that's why I watch the indicators and the charts and report on them every day. So we'll keep an eye on things for any sign of change. There doesn't appear to be anything imminent in the offing, and cycle projections do point to the 1960 to 1980 area, so we at least have a little bit further to go in the short run. In the long run, long-term cycle projections, which I just updated, now point to the 2000 to 2400 range, which is due ideally sometime next year. So we'll keep an eye on those things. In the economic news, of course, on Friday we had the jobs data, and it's the same old story. It's straight line growth in non-farm payrolls at between 1.6 and 1.8% month in and month out. Seems totally bogus, especially when you look at the household survey that shows wide fluctuations and growth of only 1.2% in the latest month. That's year to year. The seasonally adjusted numbers, as always, are suspect. So I report on the actual not seasonally adjusted data, and I posted an article on Friday in the Wall Street Examiner on the free side. Go read that. I think it'll be, if you haven't seen that, I think it'll be somewhat enlightening. But what difference does it make? As long as they continue reporting these straight line steady gains, it'll just keep the Fed on track for a slow taper. We have to watch Treasury supply. We have no new supply on Thursday when the bills settle. That's Thursday the 12th. And that is also the day that the Fed starts its mid-month period of MBS purchase settlements. And although we don't have the final total for that, that'll run 7 days or 8 days until the 19th. It should be around 30 billion or so, give or take a couple of billion. And net new Treasury supply on the 16th, when the notes and bonds settle, will be also about 30 billion. So the Fed, once again, has calibrated QE to exactly match the amount of new Treasury supply. And since there are always other buyers in addition to the Fed, that means there's going to be a lot of excess cash still slopping around in the market. One of the things that I noticed this week in updating the Fed H41 data is that the foreign central banks have started buying again. They took down a lot of the new supply at the turn of the month. And so if they're back in the game, it's not clear that that's a trend or just a 1 week wonder. We just don't know. But clearly they're at least back in the game sometimes. The public is still buying bonds. So there's more than enough liquidity around to keep this thing going, and I don't see any sign that it's about to change at any time in the near future. You know, we have to look ahead for the Fed to continue to taper and the possibility that Treasury supply will increase to the point that it is significantly greater than the amount of money the Fed is printing. That would be cause for a crunch to develop in the market. But again, I don't see any sign that that's happening. Looking at the withholding taxes in the last week or so, they have rebounded, and that rebound has actually began in May from the weakness that we saw, say, through most of April. So there's a sign that the economy is rebounding a little bit to where it was after that 6-week soft period. I just don't see anything in any of the data, whether it be the economic data, which I don't give a lot of weight to, or the liquidity or the technical analysis that would suggest that we are anywhere near a top. So the serial crash callers are out there. The top callers are still out there. The media is talking about complacency, but amongst the bear community, I still see a lot of people complaining about how this market is overbought, overstretched, over this, over that. It's all true, but the point is this. It's a point I've made repeatedly. Rigging works, and it'll work until it doesn't. And our job is to continue to watch the data closely for the signs that it is not working. And when those signs become apparent, believe me, I'll be the first to scream about it. So until we get together again next week, I might shoot for a little earlier in the week, and if I do, I will post a notice on Radio Free Wall Street and get something out in the Wall Street Examiner emails. But it'll either be Wednesday, Thursday, or Saturday again. So until we get together again, have a great week, trade sane, and I'll see you next week. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.